Welcome to one of the most shocking examples of market blunders we've seen in a long time. This time, at the hands of 5 analysts who completely dropped the ball on Estée Lauder, EL. What should have been a relatively straightforward stock analysis turned into an absolute disaster, with investors left holding the bag while these so-called experts botched their calls in ways that can only be described as reckless, or perhaps worse. How did they miss so many glaring warning signs? What data were they looking at? Or maybe, just maybe, they didn't want to see the cracks in the company's foundation. We're talking about bad calls here, really bad calls. These analysts chased the stock up during its run, only to stay silent as it plummeted. Instead of issuing the sell ratings their clients deserved, they clung to neutral recommendations and inflated price targets as if they were more interested in saving face than saving portfolios. Are we really supposed to believe they didn't see this coming? It almost feels like a cover-up. In our incompetence court today, these 5 analysts will face judgment for leading investors straight into a financial minefield. But this isn't just about airing out the incompetence of analysts. No, today's we will reveal crucial lessons for all of us trying to navigate the turbulent waters of investing. Because at the heart of Estée Lauder's collapse, there's a bigger story, a story of what happens when a company fails to adapt to changing markets and overly relies on a narrow client base. It's a reminder that in the world of tech and beyond, adaptability and diversification are the keys to survival. Stick with us, and by the end of today's deep dive, you'll not only know how Estée Lauder fell from grace, but you'll also have the tools to protect your portfolio from following the same fate. Let's tear into this mess and find out where it all went wrong. But before we do that, let's quickly shift gears. We've been diving deep into the pitfalls of bad advice and the chaos it causes in the market. But what if you didn't have to rely on analysts at all to generate income? If you've been looking for a way to build a passive revenue stream to diversify your income base, then check out Tube Magic by Matt Parr. Here's the thing. Starting a YouTube channel can feel overwhelming, especially when you're not sure how to grow it or make real money. Tube Magic solves that by offering a step-by-step system to create, grow, and monetize your YouTube channel using all of the best cutting-edge AI technologies available. You'll benefit from a clear path to making passive income, growing a real audience, and having the freedom to focus on content you love. Plus, it comes loaded with lessons for optimizing your videos and strategies for scaling quickly, so you don't waste time trying to figure it out on your own. EL stock was certainly one of recent history's biggest blunders. At its peak, the stock sat around 372, and currently it sits tired and sluggish in the high 60s. And all the analysts that we will expose today displayed gross incompetence in their handling of this matter. Order in the court. Your Honor, I bring to you our first analyst of the day, Andrea Teixeira of JP Morgan, who is being charged with gross incompetence and teasing investors with a few good calls only to lure them into the battleground where they got slaughtered by Estée Lauder. Andrea began her coverage of EL in May of 2018 with a series of buy or overweight calls that soon proved to be outright incorrect. After that, she switched to neutral in the first mini trench, only to wedge her way back up to a buy at the first mini peak. So right here, she was clearly leading investors astray, essentially telling them in the trench to sell and approaching and at the peak to buy like a fool. But this was where things got interesting. She then made a series of underweight calls that essentially shorted the stock or underbid it in her estimates, warning investors of the next peak. This was well done, but unfortunately short-lived. Had her calls ended there, it would look like a sound overall chart of competence, as her prediction of the worth of the company would have turned out to be correct. But unfortunately, she gave in to Mr. Market and her incompetent friends on Wall Street and repeated her incompetent blooper from the first mini peak by again wedging her way back up to a buy at the major peak, only to hold on to this ridiculous overweight bid and play chase with the stock price as it tumbled into the abyss. Andrea, you could literally have just done nothing when you were underbidding the stock, and you would be receiving an award. Don't give in to peer pressure. If they call you a chicken next time, just say, "I'm not a chicken, you're a turkey." Guilty as charged on both counts. Our next defendant today, Dara Mohsenian of Morgan Stanley, is being charged with a decade's worth of gross incompetence. Dara's tenure of incompetence began back in 2014 when he grabbed his pom-poms and began what would be a decade of chasing and cheering, with some mixed random neutral calls he made so as to make it look like he was actually doing his work. Then after the entire bull run and crash in the middle of the trench, Dara decided to go neutral. Really, Dara, neutral in the trench? This serves as more evidence of something we have been exposing left and right on this channel. Analysts often act as silent relationship managers between the firms they work for and the firm that they are supposed to be scrutinizing. What is the take-home lesson for you and I here? In a situation like this especially, you can confidently read a neutral call to mean get the hell out, but in this case, it didn't matter anyways, because Dara was cheering you to buy until you were already bankrupt anyways. Guilty as charged and sentenced to a life of making aggressive sell calls on all of Morgan Stanley's best iBanking clients. Our next culprit today, Rupesh Parikh of Oppenheimer, should have pleaded insanity because he surely would have gotten it. Rupesh began his coverage of EL in early 2017 and began cheering immediately. He was touting the stock as a buy and even switched his call to make it a top pick at the first mini peak right before it crashed. Then he turned around and called neutral right after the trench, only to turn around again and play chase and cheer all the way up the major bull run, again switching to top pick right before it crashed. So he obviously doesn't learn from his own mistakes. It's almost as if these guys get paid bonuses for making people lose money, but it gets even worse. After the peak, Rupesh cheered the stock along as it crashed downwards like there is no tomorrow, only to turn around in the latter half of the crash and wedge into a series of neutral calls that overbid the stock by a tremendous amount. What the hell is this guy thinking? Overbidding at 288 when it sits in the high 140s with a neutral call? At least say buy if you're going to do that. We definitely find him to be insane and are sentencing him to therapy and every Wall Street analyst's worst nightmare, drug and alcohol treatment. Our next defendant, Jason English of Goldman Sachs, is also in the Decade Club and in the Insanity Chamber. Jason began his coverage of EL in 2014. He began with a series of bipolar calls that didn't stop in his entire decade of tenure on this one. Market perform to buy to neutral to buy, in the mini trench of all places to market perform to buy. To his credit, he did make an actual sell call in the second mini trench, but unfortunately switched to neutral quickly all the way up the huge peak. Then he began to tout the stock as a buy after the crash began and held on to that into the trench, where he again wedged back into neutral, where he holds his position to this day. Absolutely bipolar and egregious. We definitely find him to be insane and are sentencing him to therapy and drug and alcohol treatment with Rupesh. Our next and final defendant in incompetence court today, Olivia Tong of Raymond James, is being charged with a decade's worth of super incompetence. Olivia began covering this stock in late 2014 and played the classic chase and cheer with the stock price, but with an odd twist of super incompetence. Right before the super peak in 2022, Olivia decided to up her bids significantly and declare this stock a strong buy. That gets some credit, as we seldom see this kind of all-in strong buy calls. But unfortunately, as stated, she made this call right before it crashed and held it all the way into the trenches, where she is currently wedging her way into a neutral call. I rest my case, Your Honor. Guilty as charged and sentenced to 10 years of unpaid number crunching in the Raymond James number crunching hall. Now that we've laid out the glaring failures of these analysts in full view, let's take a step back. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on, and dive deeper into the context that shaped this entire fiasco. The story of Estée Lauder's downfall isn't just about bad calls from analysts, it's about the company itself struggling to adapt to seismic shifts in its industry. From changing consumer behaviors to increased competition, Estée Lauder was facing challenges that went beyond just quarterly earnings. As we transition from the courtroom of incompetence to the bigger picture, we need to ask, what were the real cracks in the company's foundation? And how could they have been spotted earlier by anyone paying attention? Estée Lauder, once a leader in the luxury beauty sector, enjoyed decades of growth and brand recognition with a portfolio that included high-end lines like Clinique, MAC, and Bobbi Brown. The company was well-positioned in global markets, particularly in Asia, where affluent consumers favored its products. However, its reliance on tourism and duty-free sales proved to be a major weakness. A significant portion of Estée Lauder's revenue came from sales in airports and tourist destinations, especially from Chinese travelers. This model worked well in times of high travel demand, but when the COVID-19 pandemic brought global travel to a standstill, the company's revenue from these key markets collapsed almost overnight. Instead of diversifying its revenue sources, Estée Lauder found itself overexposed to a dwindling sector, leaving its earnings severely impacted. In addition to its dependence on tourism, Estée Lauder's narrow focus on high-end consumers left it vulnerable in an evolving beauty market. Competitors, both legacy brands and newer indie players like Fenty Beauty, capitalized on broader consumer bases and younger, more diverse audiences. Estée Lauder, by contrast, struggled to appeal to the rising generation of beauty enthusiasts who favored more inclusive and affordable brands. This strategic misalignment left the company out of touch with evolving consumer trends and unable to capture meaningful market share in the growing direct-to-consumer segment, where agile competitors thrived. The company's operational challenges compounded its problems. The pandemic created significant supply chain disruptions that Estée Lauder was slow to overcome. From manufacturing delays to product shortages and transportation issues, the company faced multiple bottlenecks that prevented it from meeting demand, even in markets that showed signs of recovery. These logistical setbacks damaged the brand's reputation for luxury and reliability, further eroding consumer confidence. On the financial side, rising costs put increasing pressure on the company's margins. Raw materials, labor, and shipping costs surged due to inflationary pressures, while the company's premium pricing strategy made it difficult to pass these higher costs onto consumers without risking its luxury positioning. As a result, operating margins were squeezed, dropping from over 16% before the pandemic to under 4% as expenses outpaced revenue. Even as e-commerce grew, it wasn't enough to offset the broader operational inefficiencies and declining profits. Financially, Estée Lauder's balance sheet began to show significant signs of stress. Also, revenue growth, once robust, slowed dramatically. The company struggled to maintain profitability, with net income plummeting while costs continued to rise. Inventory mismanagement led to excess stock, which resulted in write-downs, further hitting the company's bottom line. Despite these issues, management continued to prioritize share buybacks and dividend payouts, which only exacerbated the cash flow problems and left investors questioning the company's long-term strategy. Repeated earnings misses also weighed heavily on investor sentiment. Estée Lauder consistently failed to meet analysts' expectations, leading to a series of downward revisions in earnings guidance. This series of unmet expectations, combined with the fundamental challenges in its core business model, caused the stock to plunge from its highs of over $370 to the low 80s. Investors lost confidence in management's ability to navigate the challenges and restore profitability, which further contributed to the stock's sharp decline. Ultimately, Estée Lauder's downfall was the result of several compounding factors: an over-reliance on a fragile tourism sector, a failure to adapt to changing consumer behaviors, significant supply chain issues, rising costs, and poor financial management. The company's inability to pivot and address these problems effectively led to its stock's dramatic fall, offering a cautionary tale about the importance of adaptability, operational efficiency, and prudent financial stewardship in times of crisis. So, what can you and I take from this? First, let's talk about the overall market and business model. While it might seem logical to assume that catering to wealthy consumers is a safe bet, after all, luxury goods tend to weather economic downturns better, COVID proved that even high-end markets can be vulnerable to unexpected shocks. Estée Lauder was particularly hit hard because its business model relied heavily on travel retail and in-person sales at luxury department stores. With the pandemic halting international travel and closing physical storefronts, even the wealthiest consumers weren't spending the way they used to. So, when evaluating a company, it's crucial to assess how diversified its revenue streams are. If a business is too reliant on one sales channel or geographic region, that's a red flag. Second, let's address inflation and rising costs. Right now, every company is feeling the squeeze from surging input prices, whether it's for raw materials, labor, or shipping. But not all companies are created equal in their ability to weather this storm. Estée Lauder struggled because its luxury brand positioning made it hard to pass higher costs onto customers without damaging its prestige. For you as an investor, it's important to pick companies that have the financial strength to navigate prolonged periods of high inflation. To assess this, look at gross margins, which show how well a company is managing production costs, operating margins, which reflect overall efficiency, and free cash flow, a key indicator of financial health during tough times. Additionally, watch trends in the overall economy, such as consumer confidence and interest rates, as these will affect both company performance and investor sentiment. By paying close attention to these financial indicators, you can avoid falling into the same traps and ensure you're investing in businesses that have the resilience to survive the next storm. It is critical that we all do our own due diligence on our investments. If you fail to do this, you may just wake up one day, turn on YouTube, and find yourself sitting in the incompetence court. Feel free to check out this video if you want to delve further on how to go about analyzing financial metrics.